on household stock market participation in the aftermath of an accounting scandal. The outline for the paper is that I'm going to lay out the research questions, talk a little bit about the research design, and then describe the results. So what are the research questions that we ask in this paper? So one is, if there is a big shock in the market, how do investors react? Do they panic? Do they stay calm? Do they sell? Do they buy? What is the impact on the market through the retail investors given this shock? Are investors with direct exposure to the stock different from investors who don't have a direct exposure to the stock? So there's a difference between me being directly hit and the stock market being hit but me not being directly hit. Do I see this differently? And is the reaction to fraud an immediate response, or does it continue to persist over long horizons? So it's one of those once bitten, twice shy, right? So once I've been hit, am I permanently damaged, or do I sort of come back and resume normal activity after the shock is over? And why do we care about these questions? For two reasons. One is perhaps, increasingly behavioral finance literature has implications for asset pricing, and maybe, if we understand a little bit more about how investors behave, we will have more clue about asset pricing. More importantly, or rather, given the Indian context, I think this is important because we in India make a big hue and cry about how investors don't trust the markets. Our evidence on the trust has only come from mis-selling scandals, some of which we spoke in the first session of this conference. However, there is no direct channel that we have been able to identify between lack of trust and participation. And so this is perhaps speaks to that literature, or begins to speak to that literature in some sense. So if I wanted to understand how investors react to shocks in the market, what do we already know from existing literature? One is that if there is a crisis, it's shown that it significantly affects risk perceptions and therefore it affects trading behavior. These are two papers recently done they use the financial crisis as the event, and then they do survey based measures on how people's risk perceptions change and then how their trading behavior changes. There is one very interesting paper that looks at the occurrence of corporate frauds in the US, and they find, they also use survey data mostly, and find that as states that have seen more frauds see lower stock market participation in the household survey data largely. Okay? So they use some trading data, but the large chunk of their results come from household participation at the portfolio level in stock markets. And we know that personally experienced outcomes are overweighted compared to rational Bayesian learning. So that's also, Malmendier and Nagel, for example, look at the inflation shocks and then they see that that seems to have a permanent effect on how people react to stock markets. We come in because we are able to address two drawbacks in this literature. One is that many of these papers study an aggregate shock, so everybody in the market is affected one way or the other. Okay, whereas we are able to show look at direct impact because I held a stock that was directly affected versus an aggregate shock. So we are able to identify that difference. Also, we are able to improve upon this because most of these papers either are household survey data that are taken at a yearly frequency, or they are, even if it's trading data, then it's at best at monthly frequency. Okay, whereas we are able to come at it because we have daily holdings data, and so we know immediately when the shock hits what happens because we observe household trading behavior on a day-to-day basis. So how do we add to this literature? We are able to narrow our attention to one event known as the Enron of India, and to most of us who probably were around when the scandal happened, it's the Satyam scandal that I am talking about. I have daily holdings data from the NSDL, and that's how we are able to look at daily trading of individual investors, and it allows us to directly look at investors who were affected by fraud. So what is the research design? What's the setting? So I had mentioned that this is the Satyam scandal, and for most of us we know that Satyam was a very successful IT company in India. The promoter of Satyam was actually the poster boy of India's IT revolution, and suddenly out of the blue on January 7, 2009, he announced that he had manipulated the accounts of Satyam and to the tune of apparently 1.47 billion US dollars. And investors in Satyam are said to have lost almost 136 billion over the next month. So this was a complete surprise. And most people didn't expect it. There was an event where there was some real estate dealings probably a month back related to the Maitas companies. And so while people had begun to get worried about what's really going on, nobody expected the extent of fraud. So maybe something bad is going on, but nobody really expects a fraud of this nature, right? So in that sense, I think that this event is truly exogenous. So how do we measure withdrawal, right? There are many ways to measure withdrawal, and in this we focus on one way of measuring withdrawal really, which is that do you react and sell stock on the market? Okay. One way of withdrawal is that do I just close my accounts and never come into the market? Another way of withdrawal is to say that I would have opened a demat account, I would have been this new investor, but now I decide to just stay away from the market. So we are not looking at that kind of a withdrawal. So we are looking at withdrawal of people who are in the market, and what do they do? Do they cash out and do they just liquidate their stocks, and do they not trade more? Okay, especially do they move away from particular what they think is bad sectors, do they become more under-diversified? And this also comes from this extrapolation literature where people have shown that, you know, if there is one bad egg, you will extrapolate to similar companies and also react on them when ostensibly there is nothing wrong with them because you're just extrapolating. And of course, what is the withdrawal over the long term? So this is what we focus on in this paper. We measure three outcomes. Actually, the most important outcome is the net traded value, which is the difference of each investor between buy trades and sell trades. And here I mean money taken out or taken in. So it's possible that I might reallocate my portfolio, but then no money has been taken out or no new money has come in. And we don't focus on that as much as if money has actually been taken out and in. Okay, so that's the net traded value measure. That's our primary focus in this paper. And of course, we also look at the beta, which is coming out of a market model with the value weighted universe of Indian stocks as the market portfolio. Okay, so there are two main concerns with a study of this kind, right? Whether the event is truly exogenous, and I mentioned earlier that we argue that it was truly exogenous. Nobody really expected an accounting fraud of this scale, okay? Also, it was not related to economic conditions. So very often the argument is that when times are bad, when there is a crisis or, you know, when there is a bad business cycle, these kinds of things happen more often. And so what the result is truly related to the business cycle and not related to the firm going bad. Whereas we are able to show that while this happened in the period of the financial crisis, there wasn't really anything unusual with Satyam stocks or Nifty or the IT stocks, the other IT stocks that might speak to this particular concern. The second concern with such a work is, you know, preferences, right? Maybe the households that held Satyam are just different from households that didn't hold Satyam. And so it's not surprising that they are behaving in one way versus the other. We are able to control for selection on observables by the use of the matching methodology. So we control for this because we match on households on age in terms of the number of years that they have been in the stock market, trading intensity. So were they trading before the Satyam scandal happened or not? How often were they trading? What their portfolio beta was before and what the portfolio value was, right? So people with a very large portfolio value may be different from people with a very small portfolio value. And so we use that to match households to get clones of each other to the extent that we can, right? So our data comes from NSDL. One day before the crisis, there were about 5.6 million individual accounts in the NSDL data set. We take a stratified random. Yes, yes. We take with PAN aggregated, I mean that we have masked PAN IDs, and so if one investor has 2 or 3 accounts, because we have the masked PAN ID, we aggregate everything to the PAN ID level, right? So there is no duplication of the investor. We have summed over all his or her investments with that PAN ID. So we take a stratified random sample of investors from the NSDL universe. We sample from each state and we oversample Satyam investors in each state. So this gives us a total sample of 439,000 retail investors, and of these about 10% held Satyam stock as of 6th January 2009, one day before the crisis. And so this is the value of Satyam in their portfolio as a proportion of their total value. So roughly most people seem to have held 10% of their portfolio was Satyam stock, okay. So here's a description of the overall sample, and I think this underscores the need for a matching methodology, because as you see, there is a difference between people who held Satyam stock and people who didn't hold Satyam stock. So people who held Satyam had been in the market for longer, about 5 years, as opposed to an average of 4 years of those who did not hold Satyam stock. They were trading a lot more. Their portfolio values were a lot higher than the people who did not hold Satyam stock. Their portfolio returns were negative between the 5th and the 6th of January, and they had a higher portfolio beta, okay. And they also had more other IT stocks, so not Satyam, but other IT stocks. So there is a clear difference between households that held Satyam and households that didn't hold Satyam, and it underscores the need for a matching methodology. So once we do the matching on the 4 variables that I mentioned, we find that we pretty much get good match balance, except for the portfolio beta, where on the case statistic we don't have very good balance, but on the T-stat and on the standardized difference we do get a good balance. So this is the graph that shows you the standardized difference, how it has reduced after the matching. So we're reasonably comfortable that using the match sample will give us comparable treatment and control households for us to be able to make statements on.
Back up 2 slides ago. You chose certain 4 variants on which you're doing matching. You should then show us in this table on all these parameters.
Sure.
How the match balance has fared.
So
okay?
on these, the ones that we have chosen, the means treated and means control are already.
But that will always be the case, because you've done matching on them.
Yeah.
But on the things that you've not
Right.
matched on, if you've really managed to do a great matching,
Okay.
it should be the case that even on the things that were not explicitly matched for, you end up making
Sure,
them similar.
we'll add that. So I come now to the results. So first we begin by looking at the net traded value overall, okay? And you can see the black line are the people who held Satyam, the red line are the people who did not hold Satyam, and you see that after the Satyam crisis, there is a huge sellout by people who held Satyam. So it's not as if control investors also didn't sell, but treated investors really sold more. And this is overall sales, okay? I'm not looking at Satyam specifically here, okay? So they really sold out their equity holdings, and over these 7 days, they sold about 2.1 billion rupees of stock. Everything overall, okay? And control investors also sold, but by a much lower amount. So when I look at individuals, right, so this was an overall number. When I look at do a diff and diff regression, I'm sorry, I didn't mention that we do a diff and diff regression to look at the impact of the treated investors per se. We find that the average amount de-invested by the treated group was about 1,387 rupees, and this is about 36% of the pre-treatment average. So treated investors do sell more when there is a shock relative to the control investors, and it's about 1.2% of the portfolio value. So the left-hand column is just the rupee value of sales, the right-hand column is the rupee value as a proportion of the total portfolio value. And you see on both measures, we do see that treated investors sell more. Then we ask if this de-investment varies by exposure. Okay, so we look at the quintiles of how big Satyam was as a proportion of your overall portfolio, and were people who were more exposed to Satyam because they held, it was a larger proportion of their portfolio, did they de-invest more? And we find yes, the answer is yes. I'm coming to it, okay. So this is overall net traded value, and we say that yes, the more exposed you are to a shock, the more likely that you are going to sell, okay. Then we now come to trading on Satyam. So this is the overall traded volumes on Satyam for the same period before and after the crisis. So treated investors, out of the total de-investment of about 2.1 billion, the overall de-investment on Satyam was 1.1 billion, so that's almost 57% of the net traded value. So a large proportion of the sales by the treated investors were actually Satyam stock. However, it shows that almost 40% of it was non-Satyam stock. So not only did they sell out on Satyam, but they actually sold out on all sorts of other stocks as well. Interestingly, When it just comes to Satyam, control investors show positive traded value, which means that they bought Satyam. Okay, so while treated investors were rushing to sell Satyam, on the whole as a group, when it just comes to Satyam, control investors bought Satyam. Okay, so probably they saw this as an opportunity to buy depressed stock. I don't have a view into the mechanism as to why they were buying this stock. And so if we look at exposure of Satyam and just the sale of Satyam stock, as you can see that the more exposure you have, post the crisis, the more Satyam stock you will offload. Okay, this is just the sample of treated investors because they are the ones who had Satyam stock before the crisis. Okay, and so it does seem that the large sales were Satyam stock. But the interesting question then is, does this de-investing get carried over to other stocks? Okay, so we look at whether treated and controlled investors also sold other stocks. Like I had mentioned, in the literature, there is this whole issue of extrapolation where you would expect that just because one IT stock is bad, maybe all IT stocks are bad. Okay, and what happened to the non-IT stocks? And what you find is that while treated investors were selling Satyam and were selling IT stocks a little bit more than the control investors, when it came to the non-IT stocks, they were actually buying.
Why are you putting a state fixed effects on all? Potentially you're spoiling the result. I mean, there may be a lot of Satyam holding in Andhra Pradesh.
Yeah, so we have separate, I'm not describing the AP results in this slideshow, but we do AP results separately and we're still thinking about, maybe in the discussion I'll mention the AP results because it's also a follow-up to the conversation I had with Vijaya yesterday. So I'll just keep that aside. But I think, state FE is one way also to control investor heterogeneity. Right? So maybe people in different states are different and it helps to control for that. And if we wanted to just study AP behavior, the thing to do is to look at treated investors in AP versus treated investors outside AP. And we actually have some interesting results on that as well, though I'm not putting them in this paper.
Sorry, I have a question. So you said that treated investors actually sold more, right? Now you're saying that they actually bought non-IT stocks.
Yeah, but on the whole, they sold more. So even though they bought some non-IT stock, on the whole, their selling was more than their buying.
Okay.
Yeah. And interestingly, does this de-investing last over time? So I think this is a very interesting question because, yeah, in the first 7 days of the crisis, maybe there was an effect and you sold and you got scared, or whatever the underlying behavioral mechanism is that we don't throw light on in this paper. However, if you look at over time, and this is just 1 month's data, not 1 year's data, you find that they have again begun to start buying. So in the summary statistics, I showed you that they were larger investors and they held more. Their portfolio values were larger. So even though we match, it seems that the treated investors now are within a month have reversed their behavior from selling lots of stocks. They are now back. They're buying lots of stock, okay? So they are now actually buying more. And I think this is an interesting result and it's different from what we've seen in other papers because in other papers you find that these effects are long term. In fact, the paper that specifically looks at fraud in the US market, they find that these are really long term effects and people don't come into the market at all. We don't find that result. So we find that within a month people are actually buying more. As an economist, you always worry about some other thing that might be driving the result. And so we consider 2 threats to validity. One is, was it some other event, right? So did something else happen that we worry about that is causing this? And so here we are plotting the graph for the 16 days pre and post the event. And you'll see that I had mentioned that there was a Maitas event. And you see that there was some action around the Maitas event, but it quickly turned to normal. And again, the Satyam effect was much larger than the Maitas effect. Okay, so it's highly unlikely that the Maitas effect is driving the Satyam result. We think it is the Satyam result. Also, one of the worries always is that while we control for observables, right, we are able to select on observables. Is it unobservables that are driving the result? So something that we worry about all the time. So what we do here is that our treated group in the main results are people who held Satyam as of 6 January 2009, 1 day before the crisis. So if you held Satyam, say on 1st January 2009, but you had sold it before 6th January, then you are part of my control group. Okay. Now I could argue that a person who has ever held Satyam are more similar to each other than someone who has never touched Satyam in their life. Okay, so we restrict our control group to people who had once held Satyam, and going forward we also want to look at the date at which they exited Satyam. Okay, so did they exit Satyam after the Maitas event, or did they exit Satyam long time before, which gives us a more like to like comparison on the unobservables as well, and we find that our result largely holds. So it's unlikely that the unobservables are driving this result. So in conclusion, we find a huge impact on those exposed to fraud. We find that the investors sell the bad stock, which is the stock that suffered the fraud, and the sales increase by exposure, but they are reversed in 1 month, which means that the effect is really short-lived and they don't really extrapolate to other stocks. Thank you.
I got a mail saying that I've been allocated, just like Kaushik. Just pick it up. So the initial reaction is a shock, because I was not consented. I didn't see the paper. Then I showed a mail to Unnati saying that how can I discuss? So I just got it. So that's like the initial behavior, similar to the investors. You overshoot. Then I thought rationally, what if the author is a gene farmer? Right, so then I can't really do this. So I looked at the author's name. Then it's Renuka. So I thought I should discuss this paper. Then I looked at the content in the paper. Then I really got excited. I started reading like a comic book. So eventually I read the paper. I decided not to read the paper, which is irrational. So behavior like the investors selling the stock. Then I thought rationally that I have to do, because there is some economic incentive. Eventually, we can do some joint work later, or I can ask her to, discuss a paper or share the data at some point of time. So that was a rational decision. But eventually, the reading I had was mainly my own interest in the literature, which is not rational. So similar to the investors in this paper, and I really enjoyed reading it. So my comments follows. So investor behavior is a very interesting topic nowadays. So a lot of literature on asymmetric weights, like we give more weight to negative events than positive events. So more weight to direct exposure than indirect exposure. That's the paper. What Renuka is doing here. So the literature says that if there is a direct exposure, then the effect is permanent, like the Malmender and Nagel paper. So, however, Renuka tries to find something else. That's the story is such behavior in Renuka's paper is short-lived. So eventually, investors become more rational and with some blip of overreaction, which is in a way contradicting to the existing notion that this is more permanent. So that's the idea here in the paper. What's up? So the story, how she verifies this story. So after the announcement of accounting scandal, investors who have direct exposure to Satyam sell their stock initially, and they buy back within 1 month, compared to the control group of investors who do not have direct exposure to Satyam. Hence, the behavioral bias is short-lived. After all, investors are rational. So that's the story Renuka tries to build, and she verifies that in a beautiful way with the data. So I felt that the conclusion is somewhat not right, at least in my perspective, because I was part of a treated group. My wife was a control group of the same stock, Satyam. So I was holding Satyam at the time of this event. In fact, I bought Satyam for 315, and my wife, she has a similar size portfolio like mine, and didn't have any exposure on Satyam stock. So she is part of the control group. So once the scandal broke, I bought more Satyam, mainly because I was in panic, because I had overexposure. I wanted to cover the losses. So in fact, I gave overweight to the loss. I was exposed to direct exposed to Satyam. So in other words, buying a stock doesn't. So selling a stock alone doesn't mean you're in panic. Even buying also is part of the panic zone. So in other words, if you see that the investors bought more stock in Satyam, they would have been buying the stock purely out of panic, right? So likewise, in fact, I advise my wife to buy more so that we can cover together. So that could happen too, right? So eventually we bought a lot of stock of Satyam for 16 rupees. We're quite happy because after the Mahindra Satyam, no, we're quite rich because of Satyam stock. So that happened. So the whole decision of buying Satyam doesn't mean that we are rational, right? So I think the conclusion I feel is not right in my opinion. So in summary, selling around doesn't represent panic buying also, and some minor comments. So I think you didn't look at the futures market transactions during the same time, and why you didn't consider institutional investors at the same time. It's a good idea to report portfolio betas than, sigmas than betas, because these are individual portfolios. Most of them may not be diversified. I think it's a good idea if you can report standard deviations to see the real picture. That's about it. Thank you. Yeah.
So there's Kaushik, KP, Anjali, Lakshmi. I know. Today I remember. And that's the order. Kaushik, all yours. You had a comment. Oh, yes, and then after all that, Ajay.
So I'm just curious if this did anything to the prices of the accounting companies or the big five. I don't know if you look into that at all. You show that the control group buys Satyam, and I don't know if that's evidence of bad match balance in some way, because you're trying to construct two groups of people who are similar, except for the fact that one held Satyam and the other didn't. So is the fact that the control group post the event buys Satyam somehow proof that they're different? I don't know, I'm not sure. What else? You show the treated investors start buying again, but do they ever get back to their previous levels of total holdings? And
Actually,
how long does it take?
Yeah, that was a question I had as well. Compared to when was the question.
Yeah, that's it.
Okay, thank you. KP?
Yeah, so I found the fact that the control group was buying Satyam to be intriguing as well. So I would like to understand what kind of people were doing this. So just a summary stat on what was their characteristic like would probably give more insight. Also, I think the paper only works on retail holdings, so I'm wondering if there's any information on institutional holdings in the data set, and if that could also be separated into treatment and control groups. Another point which I had was, so you look at data 1 month after the event. I wanted to know as to why this has been done only 1 month, and also if you could give more description as to what were the things happening in the market. So I believe there was a lot of concern with the Indian government as well, and whether there were any announcements made around this event, after the event, by the government as to how they would bail out Satyam. And I also found the discussant's comments very interesting. So I was wondering if there was any statistic, summary statistic on the background or the educational qualification of investors in the two groups, the control and the treatment groups, and if that could also be controlled for.
Cool, thank you. Anjali?
So I have 2 comments, one of which KP has already raised, is that you should quickly find out the date of the government bailout, because there was and it could potentially affect. And also Vijaya makes an interesting point. I also bought Satyam at 16, right? And I was not a holder prior. So I think the announcement effect had something to do with the fact that a lot of people bought it back. The government bailout actually sort of gave that comfort. The other is perhaps the big story is aggregate effect versus isolated effect, right? So nothing else was wrong except Satyam, right? And hence, perhaps that's why the story that there is no long-term effect actually holds. I think the linked sectors to look at are not the IT sectors. The linked sectors to look at perhaps are, as Kaushik says, the auditors, and there they will not find a listing, and that's a problem. But the real estate. So the cause of the Satyam scandal was not the IT sector. It was the fact that a real estate company was going bust and they were into that business. So is it that around that time a lot of sale on real estate happened? So that's the...
Lakshmi?
Right. So Yeah, some of the questions have already been asked. So I wanted to ask, so when you started out, you wanted to emphasize the role of trust and that leads to stock market participation or not. So I didn't find anything on that, whether you want to address that. Because you want to, I mean, if you want to answer that question, you want to understand whether it's the role of trust or it's the attention that's leading to this question. So maybe you should do more work on that or maybe motivate it differently. And the other thing was, you can also look at how people make decisions under stress. So for example, like we don't know much about how people make decisions when they're stressed. So for that, you might need how much of their total portfolio is invested in equities, and then you can probably address that. And two quick references on this. So one paper is by Gurun Yonker and Noah Stoffman, The Trust Busting Effect of Fraud. So he looks at Ponzi scheme in different states and affected investors, and he gets to this question of trust. The second is by my co-author Casper, that's called Once Bitten, Twice Shy. Where he classifies experiences and then gets to one of the comments which the discussant had. Yeah, thank you.
Thanks a lot. Since Ajay is not here, we'll have the pleasure of giving the floor to you and moving on to the break.
Okay, so thank you all for the comments, and they're all very useful. Some of them are work in progress, so let me first address those that we are working on. So on your point on accounting companies, we are looking at all the companies that PwC was an accountant to, and then seeing whether that had an effect or not. So we ran out of time. So it's work in progress where we are looking at. So in terms of extrapolation, that's certainly something that we are looking at. We don't have any background data on investors, so their education, whatever else. So that's not something that we can control on. What else? On the question of institutions, again, so why did we stop at 1 month? We are going to do 1 year as well, but again, so we started with 7 days, 1 month, and going forward in the next version of the paper, we would like to do a more long-term effect. Your point on trust versus attention is very well taken. It's very difficult with this to point out whether it was actually trust, right? So it's something that we are a little agnostic about. It's hard to pinpoint just that channel given this setting. But yes, I agree that then we should motivate this a little differently. Anjali, agreed. It's the announcement date, I think, the Satyam being sold to Tech Mahindra or whatever will be critical and perhaps played a role in the buying decision. So I'm not sure whether that happens. Our results, the 7-day results where control investors are buying are still quite robust, and I'm pretty sure that in the first 7 days there was no announcement.
No, but
I think it was the step-in date.
So the government was already starting to make noise. I agree with you.
Yes, it was making noises, but that announcement happened later. And
agreed. It's just that, in terms of
bailout. See, it was not the announcement of the bailout, but the expectation of a bailout because government.
But I think that's certainly something that we should use to nuance the.
That will hurt your 1 year analysis. Government intervention.
Post the government intervention, I mean, it could be a trigger in people's.
You can't really observe that.
So 1 year later, we might for the 1 year analysis, we might interpret this differently because the announcement came. But I mean, the fact that people were thinking that something is going to happen and the government is going to take some action is likely to have impacted the control behavior's decision, and it's certainly something we should factor in. And to your point that even buying can be a panic buying, I think that's a very interesting point, and we'll think about it, how to address it in this paper.
Since Ajay is back, you have 1 minute, please, and I'm going to cut off your thing in 1 minute.
When the government intervention began, I think that it was pretty hopeless in the minds of most people. Ex-post, it was a remarkable intervention that we look back at saying, wow, you mean Government of India can do this? At the time, getting Deepak Parekh and some blokes to try to help Satyam was a hopeless cause.
But that really increased the price of Satyam once Deepak Parekh came to rescue.
Yeah, let's not second guess what the perception is. I think that
but it's an objective date, and so we just have to be careful to keep away from that date.
Right? I mean, that should be factored into this analysis. Okay, cool. Thank you very much. We'll take the discussions in the break session.